So you millennials, you should have listened to CMHC. You should have. Nobody else should have because every other prediction was wrong. But you guys definitely should have listened to CMHC. That is unless you didn't get the message. Maybe you guys didn't hear it. Maybe your cell phone died, which reminds me. Good morning, investors. Bradley here from Watson Estates. You're listening to the largest, fast-growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. Thank you for joining us this beautiful Tuesday morning, friends. I'm so glad that you can make it. And today we're going to cover some great stuff as it relates to the real estate market. I, as an investor and a broker, want to know for myself and for my clients what comes next in our market. And if you're ignoring these items today, you've missed the whole point. So we're going to start off talking about what are rents across all property types doing in the GTA. We've talked a lot about condos, but what happens everywhere else? And what is that and how is that impacting our market as a whole? Then we're going to jump into this idea of Barcelona has come up with this incredible plan on how to tackle their Airbnb crisis. Is it something that we can copy today? And in some ways, I think we might actually be taking steps in that direction. Also, why are economists and Canadians so pessimistic about our marketplace? We're going to talk about what they have to say is going to happen into the fourth quarter of 2020, rounding into the new year. But today is a beautiful day. It's a beautiful day to talk about podcasting, but I also have a really full day after this. I've got back-to-back on my schedule. We've got phone calls, and I'm just kind of looking at it, and I've been planning this day for the last few days. I've been taking steps to prepare for such a heavy schedule by deleting all my German friends from my phone. It's now Hans free. Trying to keep up, but you know me. I love talking to people. I love these conversations, hence why we do this podcast, why we have so much fun here as much as we can to keep you guys up to date. And I guess you could say that I've found my calling. We're going to crack some dad jokes along the way talking about real estate, but also why not add in a little bit of fun, a little bit of playfulness. That's really what makes our channel great. Making real estate great again, as some of the people have said. I don't know if that's a good thing. It's not a good reference these days. So let's talk about rents, shall we? Let's talk about what is the average rent doing, not just in the condo space, but in all segments. We're going to start off with a TorontoStories.com article that says, average rent across all property types in the GTA down 12.9% annually. That's the average, and that's all housing types. Many of you might not realize that across the GTA, we're getting hard hit. We've said this in past podcasts too. It's obviously not getting all the glory that the condos are, but it's important to note that rental rates have gone down as a whole and on average. The average rent for all home types in the GTA are down nearly 13%, according to a new report from Toronto Rentals. According to the report, the average rent for all property types listed on TorontoRentals.com, which includes basement apartments, rental apartments, condo apartments, townhouses, and other single-family homes fell just under 13%, or 2.4% month over month to 2,131, marking the 10th consecutive monthly decline. However, the months of price declines are expected to come to an end. This is according to PadMapper. I mean, I thought we were coming to an end before, so let's see what happens here. Who previously suggested that the rent-free fall, I guess is how you say it, the rent-free fall, not rent-free fall. I mean, because we had a rent-free summer, I don't want a rent-free fall now. In Toronto, may be winding down, and soon as Canada's priciest rental markets are expected to hit a price, quote, floor. So where's the price floor? Landlords like myself are hoping it's now or a while ago, but it's still been going down. It'll be interesting to see where the bottom is. And they've got this little chart, kind of cool. You can kind of see it started off back in January through to March. We were up anywhere from 3.5% to almost 6% year over year average rent as a whole in the GTA. But now in August, we were down just under 11%. And now at the end of September, which is where the stats end here, just under 13%. That's a big change. All the way from climbing all the way to declining, not to mention the prices, the issues we've seen, the prices that have kind of fallen out of that. And we're going to talk about that in a minute. But let's look at the specific types of units, depending on what kind of rental you have in your portfolio. Here's what they're doing. Studios have declined 7.9%. One bedroom and two bedroom units have the worst at 11% for a 1 and a 9.3 respectively for the 2. As well, 3-bedroom units have fallen 4.4%, and the 4-bedroom units somehow increased by 4.5%. Now, does this come as any mystery, the idea that more residents are looking for space? outside the confounds of the downtown core? Not really. Not really. And so that goes to show you the ones hardest hit are those smaller micro units, or really the one bedrooms are the ones taking the biggest hit. The cookie cutters. Now in Toronto, all 10 neighborhoods included in the report experienced a decline, with 7 of them experiencing double-digit deflation in their average rent per square foot year over year. So there is no question that Toronto, and specifically the downtown core, Old Toronto, as they like to refer to it sometimes, that area has been hit the most. It's been hit the most as far as price drops. They say this. What's more, Toronto Rental says investors who own condo apartments in the GTA that previously rented them out are now starting to list their units for sale as downtown tenant demand shifts and resale condo supply has, quote, skyrocketed. We've seen articles that call this skyrocketing. Is it pushing people to sell? Absolutely. Is it making the appeal of being an investor that rents out a condo decline? Absolutely. People are really feeling the sting. They've got no choice but now to call up the realtor and say, hey, look, I need you to list these units for me. Sending out an SMS. My voice. And it's kind of shot because when you drink coffee, I don't know about you guys, when I drink coffee in the morning, it shoots my voice, which is perfect for setting up for a podcast. But you know what? It's a give and take. My voice sounds like garbage. Meanwhile, my energy is on fleek. All right. Urban Nation, you remember, even when they looked at the purpose-built rental units, the vacancy rates were down we're up at 2.4%, which we talked about. That is very unusual given last year they're up 0.7%. And I saw this really interesting Twitter post. I thought this was a good spot to add this in from Zealand. Treb doesn't publish active rental inventory. Yet it's one of the most important statistics today because we even see the number of rental units going up a lot. Like there's a lot of units going up. So if you just saw that, you'd think, oh, that's great. But really it's this active. How many are actively on the market? Then they say this, luckily it can be estimated with a reasonable level of accuracy. Here's the historical context. And they've got this little chart that kind of shows the bumping along of the rental listings in GTA. And all of a sudden, obviously in Q2, you can expect that number skyrockets from floating definitely under 6,000 to now shooting all the way up to over 16,000. And they say this, inventory must go down to 3,000 before the GTA rental market stabilizes. So however you paint this picture, that spread is massive and climbing, has not reduced yet. So, and whenever that balances back out, that's when you can see that floor, as they mentioned in the Pad Mapper report. So looking forward, they wrap up in this article. Toronto rentals say this, quote, weakness is expected to persist at the work from home phenomenon that's currently in place for many employers will continue moving forward. So we're going to have this issue on an ongoing basis, but I like this point too. That being said, employment is continuing to pick up and international students are now allowed to enter or re-enter the country. We've talked about this as well. They're making it a lot easier for these universities to have students come now, which they say will likely cause the vacancy rate to improve. We will see. We will watch and we will see. But how has this translated? A lot of you investors, you probably have rental units, so you care about the rental side, but we want to know, how has this translated into property values? Because if you're playing in downtown core, really, who gives a damn if you're collecting $100 less per month? The main thing here is I want my appreciation. Give me that equity. That's why I'm here in the first place. Well, for those of you who are just starting out, maybe you're a first-time home buyer, you guys will remember that CMHC warned you, they warned you against everyone's better judgment. They said, you guys should not be buying a condo at 5% down. You'll be at risk. Here's what an article from Better Dwelling likes to say. First-time home buyers were warned at the beginning of the pandemic, and a lot didn't listen. Now some are seeing exactly what the Canadian Mortgage and Housing Corporation, CMHC, warned. Canada's Real Estate Association condo apartment price data, which came out recently. We didn't cover it in the podcast because who cares? I mean, we just look at Toronto, but obviously the Canadian numbers are good too. They show a few markets have seen buyers lose a chunk of their down payment. There are some exceptions, but two of the largest condo markets, aka Toronto and Vancouver, were not. So you millennials, you should have listened to CMHC. You should have. Nobody else should have because every other prediction is wrong. But you guys definitely should have listened to CMHC. That is unless you didn't get the message. Maybe you guys didn't hear it. Maybe your cell phone died, which reminds me. That reminds me that my roommate in college, his phone died and he wanted me to tell you guys that he's a vegan. So here are the calculations. They ran a couple calculations just to kind of figure out. So if you were to put down and went against the advice of CMHC and obviously Better Dwelling, because Better Dwelling puts their stamp of approval behind all of these types of things. There are two things that they're looking at. Number one, they assume a 5% down payment because it's the demographic the CMHC warned to buy. So this is the ones that they said, be careful if you're putting 5% down. The return on investment on the 5% down and estimated equity. So if you were to put 5% down back in April when they told you don't, now where would you stand? We're going to talk about that. The second thing we're going to look at is the estimate of how much equity the condo buyer has remaining now. So given that if you had a number go down based on the pay down on your mortgage, how much equity would you have today? Well, I'm going to just cut to the chase and give you those stats. Number one, if you were to put 5% down in a condo against the advice of our friends at CMHC, the price of a typical condo has fallen 1.86% from April, or about $11,000, they say. That would be when insurance is included, the fees, the insurances, all your costs of running it, it actually ends up being negative in Toronto. Negative at 111% drop. That is your return on equity, minus 111%. Way to go. This is why you don't play the market if you're not savvy, right? In other words, the down payment was completely wiped out and then some because you paid along the way. This is one of those cases where homeowners made payments to get barely above water, as they say. What about the second one? What about their equity position today? So we know you're making the mortgage payments, you're paying down the equity. Well, in Toronto, which is what I'm primarily focused on here, they're the last on the group here as far as where you stand. And if it costs you 5%, they say one of the things I wanted to mention here, it's very key to mention if you have less than 5% equity in your home, when you go to sell that property, that is your cost of selling. You know, you got your moving, you got your real estate, you got your fees and your lawyers. Often it can be higher than 5%. Well, that's a key number then. We need to make sure we keep at least our 5%. Well, we know we've had drops, but where do we stand today? The equity position of those first-time home buyers, they say, would be, from what I can see, under 1%. It's less than 1%, which is crazy. That is crazy. These folks are definitely underwater. They went ahead, they drove their car into a river, and they watched it turn into a phone. What does that mean? That means the dad joke's coming, folks. It's 1 minute a Kia, and the next minute, no Kia. All right, well, condos won't stay down forever, and this is kind of what we're watching for. And I saw an interesting post. If there's a light at the end of the tunnel, here is a light. I don't know if it's the end, but maybe there's a window along the tunnel somewhere. Scott Ingram posted a Twitter post, and what it says here is weekly 416 sales stats, Monday through Sunday thread, big bounce back for condos, largest week since the end of August, which is 8 weeks. Bounce back in condos, okay? They'd been slowly drifting down since mid-August peak. So it's interesting to say, I'm not saying this is a reversal in the trend, but it's the first time in the last 8 weeks we've seen the condo number of sales going up. We've seen a bump. So it'll be interesting to see if that means anything substantial. Obviously, the number of listings on the market is crazy, and we're going to need a substantial change. But funny how things tend to bounce at the moment the media picks it up. What about everywhere else? And I thought, you know what, I'm going to leave the freehold to a point here from Tan Sabri. Thank you for your comment. We have great listeners who leave fantastic comments. I am an appraiser. I see price hikes everywhere. Lots of rich people are moving into the country. Most of them, like Ontario and GTA, I don't see the prices coming down. Instead, it is increasing and moving upwards, and will continue to move upwards down due to low interest rates. This is not advice, but just an opinion, and I accept no responsibility. LOL. They understand. They're in the business. They understand. I'm not going to take any responsibility. Don't listen to me. I mean, I say that all the time. But there you go. There's an appraiser giving their 2 cents into the market. Okay. Now, I want to transition here. We've talked a little bit about rents, but I want to talk about Airbnb, because Airbnb is a crisis. I guess that's a good word for it. Here in the GTA, especially in Toronto. And Toronto has had a lot to say about how they're going to deal with Airbnb. They're going to create a fee. They want you to register. Maybe these steps are a first step in a direction to copy what we see has just been applied and is single-handedly seems to have fixed the Airbnb crisis in a little place called Barcelona. Bloomberg.com had this great article. The question for us is, are we going to follow suit? Because finally someone's figured out maybe the solution to how we're going to deal with Airbnb. And it's really come in the way of strong arming them into collecting data and then dealing with the lawbreakers. Okay, Barcelona's efforts to rid itself of illegal vacation apartments could be the most effective crackdown on Airbnb yet. Last month, the city told the site to remove, they told Airbnb to remove 2,577 listings that it found to be operating without a city-approved license. Well, we don't have city-approved licenses. Well, we do. Toronto's working on that system, and you need to be registered by the new year. Or they say if you don't have an approved license, you face court case potentially leading to substantial fines. Then on June 1st, Airbnb and the city launched a new agreement that gives Barcelona officials access to data about what's being listed around town. So finally, Airbnb there's been a crack in the system where now they're allowing officials to get access to that data. Data. That's how it's said around my place. For the first time, city officials will be able to refer to host data that details specifically where apartments are located and who their registered hosts are. Interesting. Very interesting. Something that could previously require substantial investigation. They will be able to track these host ID numbers to verify that their linked apartments do indeed have permission, and it will be far easier to pursue rule breakers and, if necessary, fine them. Because of this access to information, they're able to crack down in a very real way. They can backtrack these numbers, see who's registered, and they're even adding it before I go to one more thing they're going to do here, which I think is very valid and worthwhile. They say it has global significance. It really does. That's why this is such a big article. They say it provides a ready-to-go model that makes enforcing local rules not just feasible, but relatively easy. They show that concerted pressure from local governments can indeed push Airbnb and other home sharing sites to take real action. Now, here's the one thing I want to say. In the future, they propose changes to the Airbnb Barcelona's listings template may make enforcement even easier, because they're going to take it to another level down the road. Forget that we were able to already take out tens of thousands of listings. Down the road, they say one option being considered would have all hosts in the city submit their rental permit number to Airbnb before it goes live. So if you're going to post it on our website, you need to prove that it's going to go live. What a fantastic idea. If the box were left blank or filled in with a false number, instantly detectable by the system, by the way, the listing would not appear on the site. This to me makes sense. This seems to be the way that this should be run. Is this what's going to happen in Toronto? We will see. But Barcelona has a plan to make it all go away. It's like those signs on the bus stop. You know, when you're kind of waiting for the bus. Yeah, I know you guys don't wait on buses. And it says, we have a solution. Take a number and call now. Well, let's see if this solution can work here in Toronto or if it's just like those bus stop signs is just a ripoff. But one of the things that I think is valid that points to Toronto maybe doing this, there was actually a post on the Airbnb website. It kind of popped up. It's a prompt. It says, register by December 31st to keep hosting. If you haven't had a chance to register your listing in Toronto, now is a good time to get started. The city's application deadline is December 31st, and listings that aren't registered will be deactivated or blocked from hosting short-term stays on January 8th. They're giving a date. They're saying you're going to be shut down on January 8th. Because it can take some time for the city to review and approve your application, we recommend starting the process soon. Is this a bluff? Are they actually going to do it? Because they're doing it in Barcelona. I think it's necessary, but it's going to obviously mean a killer blow to you Airbnb owners out there, or people operating, which is a large chunk of people, illegal Airbnbs. Very interesting. Definitely a good solution to dealing with housing, because although you guys think, oh, well, rental rates are going down and it's a bad time to rent a condo, have no fear. There will come a time when the rent rates will go way back up because the number of units are way down. And so dealing with this Airbnb thing is going to help us down the road. Okay, let's take a little pause here. Do a little bit of a change of scenery, and we're going to talk about our hot topics today. And I want to start off with a conversation from FP on YouTube. It's a great question. I'm hearing about the Smith's maneuver. What is this? Some of you savvy investors out there might know the Smith's maneuver. You might be doing the Smith's maneuver and don't even know you're doing it. Well, let me kind of explain it a little bit, and I highly recommend you guys look this up online because I can't do it justice in the next little while here. But I want to give you guys an insight if you've maybe never heard of it. It's a great opportunity for you guys out there. So listen to this. So there's two things, right? Think of an expense, right? You've got expenses that are deductible, so you can reduce them off your income if you're self-employed or have a business, you know that. If you don't have a business, now you know that. Then there's those that are non-deductible. There's things that you can't just deduct that. Well, The whole concept of the Smith maneuver is in the US, they can do it in the States, but there was no way for people to do it in Canada. Why can't I have my mortgage be deductible? Meaning I want to reduce my income from the expenses of the interest payment on my mortgage. Well, there was no way to do this until the Smith maneuver. So just to give you guys an example. So let's say you've got a $1 million house, right? You got 20% down. So you got an $800,000 mortgage at 2%. The numbers for that, your monthly payment would be $3,387. The interest of that would be $1,328. Now let's say $200,000 of that was deductible. So you got an $800,000 mortgage, $200,000 is deductible. In that scenario, that portion, because that mortgage is, in other words, being used for something to generate income. And this is the key for the Smith maneuver. If you have a mortgage and the money is taken out in the form of a line of credit, you kind of withdraw it and apply it to some kind of investment, whether that's a business, stocks, real estate. In these scenarios, you can now get a deduction for the interest rate paid on that portion of your mortgage. That's the key here. So in that scenario, if 200,000 of the 800,000 is deductible, that would mean it would equate to, in the interest payments, a deduction of $3,984 for the year. And if you're at a tax rate of, call it 40%, that's $1,593 a year. That's $2,000 a year. Now, if the whole amount, if you're able to, in a way, get your entire mortgage to be deductible, which is the ultimate goal, in that scenario, you would actually save yourself in taxes, that is off your income at a 40th marginal tax rate, $6,300, $6,347 per year. $6,000 in your pocket. What do you do with the $6,000? You circle it back into the mortgage and you eat that mortgage. And there's these debt strategies that they employ under the Smith maneuver that you can pay down that mortgage quicker. That's the basics of it. The whole premise of a Smith maneuver is converting your non-deductible mortgage into a deductible mortgage. If you've never heard of this concept, I highly encourage you guys to check it out online. It's a great idea. Some people might think, you know what, my goal is to pay off the mortgage, and that's perfectly fine. If you're an investor, oftentimes the goal is not to pay off the mortgage, it's to generate a cash flow and to be in the game. But regardless of the goal, if you're going to have a mortgage, might as well be deductible. Might as well save yourself a little bit of money. All right, let's go to another hot topic. Sudbury landlords plan protest over tribunal delays. I thought this was a great article because it really explains the backlog that exists at the LTB. The LTB, Landlord and Tenant Board, is supposed to schedule a first hearing date within 25 days of an application for the most common rent disputes. Now listen to this. In 2018 and 2019, not this year, last year, it met that standard just 35% of the time. So it couldn't even keep up with those standards. Remember how we say how backlogged the LTB is? That's what I'm talking about. In January, the provincial ombudsman launched an investigation into delays with the Landlord and Tenant Board. And by the way, that investigation is still going to this day. Monique Ladaroute, Sudbury paralegal, says the board needs more staff than just adjudicators and says newly appointed adjudicators often need training before they're able to handle complex cases, meaning she expects delays to continue. Here's what she says, this is a quote. "This is a system that is broken and they're not being funded to repair." And with 2020 stacking up, and this article, I'm not going to get into it, talks about how we need a moratorium again. Let's just continue this backlog, add them all up. Good luck trying to get that tenant out, that pesky tenant. What a pain in the butt. What a pain in the butt. And LTB clearly needs to be funded and supported in new and better ways. Okay, moving on. I saw a post from Steve Saretsky. This was another article that you might have seen talking about the central bank buying bonds, but I love his post better because he summarized it. Bank of Canada will own more than 50% of the Canadian bond market by this time next year. Oh my goodness. They have pledged to continue buying bonds until the nation's recovery is, quote, well underway. So the bond buying, although the mortgage-backed security thing is done, the bond buying program continues. And if the bonds are worth anything, the Bank of Canada is growing its assets quite substantially. Another fun fact, for those of you who are investors or realtors out there, you might be operating a small business. The CEBA, you've probably heard, is now available if you're running a personal bank account. Before you needed a business bank account. Now it's available if you have a personal one, as long as your expenses, talking about deductions, is over $40,000 per year. That's things like rent, phone, you get the deal. But if you got no expenses, then forget it, right? Like maybe you're running a business like the guy that I see every so often at the cafe, right? I don't know what kind of business he's running. He's got no cell phone. He's got no laptop. Right? He's got no tablet, just sitting there, drinking coffee, like a psychopath. And another post that I saw that was great, despite a sharp plunge in GDP, global property prices are rising. Just to point to the fact that we are not the only one. This is an article here from BIS, and it kind of maps out the different house prices, and they're just showing that generally speaking, house prices are up around the world. I mean, there's a few exceptions, or Spain, Hong Kong, and Finland. Other than that, all these prices are up. And meanwhile, the nominal GDP seems to be down. And so this is just like almost all, other than mainland China, everyone's GDP is down. So why are prices going up? Maybe it's a currency issue. Maybe people are looking for fixed assets to save themselves from the impending doom. All that to say, it's not just Toronto. So you guys think, oh, Toronto's in a bubble. Well, the world's in a bubble. Welcome to the bubble, the flat earth theory with the bubble. Anyways, okay. So let's go into our last topic here. What are economists and Canadians so pessimistic about? Right? Why are they so upset? Just relax. We're good. We're good. Everybody's bad, right? It's the clean dirty t-shirt theory. We're the less dirty t-shirt. We'll put that one on. That's a good one. People are going to come here. Well, here's what the Economists think from a Huffington Post article. What comes next due to COVID in our economy? The Canadian economic recovery from the coronavirus will be significantly slower than previous thought, with a high risk of resurgence in cases will halt the rebound underway, according to a Reuters poll of economists. So this poll was taking place between October 15th and 21st. It had nearly 50 economists predicting the economy expanded a record annualized 44.5% in Q3, faster than the 30% growth predicted in July. So Q3 was good. We outperformed in Q3, but growth was expected to slow to 5% and 5.2% in Q4 2020 and Q1 2021. So Q3, people expected to be pretty good, and we overshot that expectation. Now, people aren't so sure. People are not so sure. In fact, they're convinced we're going to see things slow down between now and next quarter. Those forecasts for the current quarter and early next year was significantly lower than the 10% and 7% predicted just 3 months ago. Maybe it's balancing out, right? Maybe we overdid Q3, but we're going to bounce back in Q4. I don't know. But it would seem as though the economists' predictions are rather grim. And they say nearly 60% of respondents, or 12 of 21, to an additional question said that the resurgence in coronavirus cases would halt the recovery was, quote, either high or very high. So coronavirus seems to be the issue. And when they talk about negative interest rates, they all say lowering interest rates below zero would likely have only a marginal impact on economic growth. However, the potential downside implications of such a move on the financial system and broader economy would likely outweigh any positive impact. So in other words, negative interest rates is not the solution, according to these economists. No duh. Okay. Well, what do Canadians have to say? Well, there was an article, actually a popular article yesterday, Financial Post. Canada becomes a country of pessimists with economic gloom deepening on rising virus cases. It says this: fewer consumers are feeling optimistic about Canada's economic prospects. Another signal the initially robust recovery is entering a slower, more difficult phase. Okay, so we had growth, but based on what Canadians and economists are saying, it's not going to continue. Only 12.9% of respondents believe the country's economy will strengthen in the next 6 months, the smallest share since early May, telephone polling shows. The share of respondents who see the Canadian economy weakening in the next 6 months rose to 56%, which means pessimists now outnumber optimists about 4-1. 4-1. So four out of 5 people. Is that how that works? I guess so. 4-1. I guess so. Forget the math. We don't deal with numbers around here. 80% of the time. Why do people feel this way? Weakening sentiments in Canada reflect the new containment measures provinces like Quebec and Ontario have imposed in deepening a second wave. So like the economists, the reason for the pessimism here in Canada and here in Ontario is because we feel like the government is putting way too much of a noose around our neck. Right? We really need to allow businesses to continue, right? Credit card growth, for example, in October slowed with the new measures being implemented, according to TD. And here's a perfect example of the shotgun, the Doug Ford shotgun. We talked about that on Sunday. Well, apparently the don't shoot from Halton was enough to stop the trigger being fired. Halton, Durham region now not moving into modified stage 2 as of now. Politicians in Halton urge the province not to lump them in the neighboring Peel region, saying there aren't as many COVID cases in the area as elsewhere in the province. And Ford, like a good boy, put his gun away for now. Right, for now. Whether you're an Android user or the other, less important one, I'm going to wrap up here. Just make sure, all things considered, that you're not using a Huawei. A Hua? A Hua? I used to use a Huawei. I actually did. I called it Huawei. And but I don't recommend any of you using it because I used to always get calls from the wrong people. But first, the Canadian government, they blocked China. Then what comes next? We blocked the Middle East. Next thing you know, we've created the Taliban. I hope you guys had some fun, learned some stuff. Tomorrow we have a video coming out with a large investor. I hope you guys enjoy it. I'd like to get big guests on our show out from Hamilton talking about a massive portfolio. I can't even remember the numbers now. It's significant, very significant. Also a property manager, also a renovator. And so I hope you guys enjoyed that. And I'm hoping to be back later in the week with some more. And as well, if you're not already on our list, make sure you subscribe. I'm going to be sending out a deal on tomorrow, actually. So make sure you subscribe. Today's Tuesday if you want to get on that. It's an off-market triplex up in Aurelia that I've got access to. It's not on the market yet. So if you guys want to get access to off-market deals or high cash flow properties, this one's actually 16% ROI in the first year. Very good deals. We're sharing those out with you guys as a thank you for continuing to join us on our podcast and as a family. And I will see you guys next time. Take care and keep it real.